Hey, what's going on? Today, I want to give you an update on interest rates. Most of the economy evolves around interest rates because people borrow money for so many different things: houses, cars, credit cards, personal loans, business loans, and government loans. And I saved the best for last because the government is the biggest, most stable borrower there is because they got the money printer and they have the world reserve currency. And so it puts them in a position to where they're the most trustworthy and they create competition for everybody else who wants to borrow money. So because of that, there's a correlation between government bonds and which is government loans and any other type of loan you try to take out. And so, since the government is a lot more stable than you are, they got the money printer, they have a very low risk of not having the money. There's typically going to be a spread in between um, the interest rate that they borrow it versus the interest rate that you borrow it. With that being said, there's always going to be a correlation between the rates. So if you want to get an idea of what's going to happen with interest rates, it's a good idea to look at what's happening with government bonds. And so we have the Federal Reserve and we have the Treasury, and both of them are competitors to everybody else that's borrowing money. The Federal Reserve has what they call the overnight deposit rate. I think that's what it's called. And so they allow banks to deposit their money with the Federal Reserve and get a return on their investment. Um, and the Federal Reserve controls that rate. And the Treasury is where the government borrows money, and so they issue out bonds, and those bonds are auctioned off on the public market. I think it's mostly banks that bid on those, but they're auctioned off on the public market, and so whatever the market dictates, that's what those rates are gonna be. And so people think that the Federal Reserve controls the interest rates, but they really don't. The Fed rates tend to follow the 10-year Treasury. And so we're going to take a look at both of those right now. And just as a side note, all loans are investments. So one man's debt is another man's investment. And the interest rate is the rate of return that the lender gets for taking a risk on lending that money. So now let's take a look at the charts. And spoiler alert, the rates are going to rise. So we're going to get into the chart and take a look at why I believe the rates are going to rise. So here we have the 10-year Treasury, the US government bond 10-year yield, and here we have the federal funds rate. And if you take a quick glance and kind of memorize it, when I switch, they look a lot similar. Let me zoom out a little bit. And so they look a lot similar. Okay. And that's because the Fed funds rate typically follows the 10-year Treasury rate. And so there's three main reasons why I believe the rates are going to rise. And so reason number one is Elliot wave theory. This this five wave count that I have here, one, two, three, four, and five. That's my Elliott wave count. I'll explain that in a minute. for this situation. And reason number two is this line right here, this red line, being the long-term moving average. I forgot what number. Let me take a look real quick. 233. And we are on the monthly chart. So this is the 233 month moving average. And it's a Fibonacci number. I won't get into all the details of that, but that's the reason why I use 233 and also, what's the other one I use? And 55. So the red one is 233 and the green one is 255. So the 233 is the slow moving average, and the 55 is the faster moving average. As you can see, the slow one is a lot smoother, and the fast one is a lot more wiggly. But I won't go into details on that. I'll explain enough to give you a picture of what I'm talking about, so you'll be able to understand it. Whether you are familiar with moving averages or Elliot wave theory or not, you should be able to follow this video. But the third reason is this line here, this red dashed line right here, which is the long-term support, going all the way back. This chart goes back to 1913. And so I will explain why this is a long-term support. So yeah, those are my three reasons. And let's start off first with the long-term support. So support and resistance is a technical analysis style. And the basic idea of support and resistance is that if a chart gets to a certain price, the charts tend to repeat the same prices or whatever. So if it gets to that price once, for example, I'll just show it to you. It's kind of hard to explain with words, but so if we go back all the way here to what year is this? This is 1927, man. So you see that's the first time that the interest rate touched this dash line. And then once it touched this line, it came down and then it bounced. So it had a reaction. It so that means if it bounces up, that means this line is acting as support. And then it went down again, and then it bounced up again. So it acted as support again. And then finally, it had enough momentum to break through and get below that line. And then it stayed below for a while. Then it started going back up. Then it tried to go back above that line, but it got rejected. And so it hit the line and went down. So that's called resistance. And so it went down, and then it tried to go up again. And it had enough momentum to get above that line. And we can see a little bit of back and forth here. And so basically what that explains is that if the price is above the line, then it's acting as support. If the price is below the line, then it acts as resistance. And so we can see how many times did this chart hit this same area. And the more times the chart hits the same area, then that's a sign that that's a stronger area of support and resistance. So if we look all the way over here in 2003, that's when the interest rates finally came back down, and they hit that exact point. And it's not a coincidence. You can see how precise it is. It hit that exact point. And you would think that's a coincidence, but it's not a coincidence. It's because this has already been proven to be a significant area of support and resistance all the way back, like we just looked at, since way back in 1928. That's the way these charts work. Support and resistance is one of the most important technical analysis strategies. And so here it got close, but it didn't quite touch the line, and then it bounced up. It had enough momentum. It went down, then it came back up again. Uh, it didn't hold that time, but when it got back up above, it hit that line again right here, and then it bounced. Then it kind of went back and forth, and you can see some of these smaller candles, like this green candle here and the red candle here. They those single candles touch the support and resistance line, and then if you like, let's zoom in a little bit, so you can see these candles keep touching that same line, and here it goes down and gets back to the same area. It doesn't quite touch it, but it gets close, and so it goes back and forth a little bit, and then the same thing here again. It hit that resistance and went down real hard. And so again here, it went back up and hit that resistance. It went down, but it quickly turned around and got enough momentum to get above that resistance line. And so here, it came down and tried to go through the support, but the support was strong enough to hold. And so then it had a reaction. It bounced up, and then it kind of went back and forth here. And so this support is holding really strong. So that's one sign. I think this support is not going to get broken anytime soon. Uh, and as I go through these three different reasons, it'll become a little bit more clear. And so let's look at the moving average. So first of all, the moving average also acts as support and resistance. And so here is where the moving average begins, the red one. The price is below the line, and then it breaks through that moving average, and then it's above the line. Then it becomes like support, and it stays above, and then it gets enough momentum to break under, and then that moving average becomes resistance. And so it keeps going back and forth, getting close to the area of that moving average, but it doesn't quite get above it. It keeps getting rejected until finally it gets enough momentum to get above that moving average, and then it comes down and it lands, and the support holds. And so you can see it goes back and forth, and it's the support right here is holding. And coincidentally, it might seem like a coincidence, but it's not. That moving average is in the same area where this red dash line is. So they're sending the same signal of support. Another key to the moving averages is, the reason why we have a fast and a slow moving average is that we can see here, we can watch the behavior of how those moving averages interact with each other. Whenever they have a cross, like right here, it signals a change in the trend. So the trend is reversing. So here the trend was going down, and then those moving averages crossed each other, and the green line was at the bottom, which is the fast moving average. It was at the bottom, which signals a downtrend, and now it flipped to the top, which signals an uptrend, and it stayed in the uptrend. And when the trend reversed up here, it crossed again, and now the fast moving average is at the bottom, and it stays at the bottom all the way until the trend reverses again. And here we have a cross. Now the fast moving average is back on top, and if you see, once that cross happens, it kind of stays there for a while. It doesn't just it doesn't just go back and forth too much. So we have one cross here, and in the past, since what was this 1940, we've only had two crosses, and we see a clear uptrend here and a clear downtrend here when those crosses happen. So that should give you an idea what should happen right here. Now that we had a third cross, it should signal a continued uptrend. And so my third reason for thinking the interest rates are going to stay up, they're going to go up, is it's my favorite, the Elliot wave theory. The Elliot wave theory is it states that the market tends to move in a 5-wave count. And here you can see, I'll go to the weekly chart to zoom in a little bit, but all right, let's close this. So here you have wave 1, 2, 3, 4, and 5 is not finished. I believe it started here, but it's not finished. And so basically, Elliott wave, according to Elliott wave, wave 5 has to come above the top of this wave 3 here. So over here, it's 5.047%, or let's see, basically 5%. So it has to get back above 5%. That's the minimum. This wave could be just as strong as this wave here was, this wave 3 was, and that would mean that these rates would get up to 8%. But it's not a guarantee that it's going to get that high. The only guarantee, according to Elliott wave, is that it has to get above here. So anywhere within this range is reasonable for the interest rates to go. And once that wave 5 finishes, then the interest rates are going to start going back down. It'll have some type of zigzag, chaotic looking pattern, but in general, it's going to go down. And let me change this. And so what's important for you to pay attention to is this part right here. How low will interest rates go down when they finally go back down? Because a lot of people are looking at these rates and waiting for some relief. But I don't think you're going to get it based on my analysis in the chart. So typically, in this type of a pattern, this is a wave 3 extension. I won't go into the details, but typically when that happens, when wave 5 is finished and the correction happens, it typically ends right here at the bottom of wave 4. So that's why I stopped it right here. It's gonna go up, then come down right to that same range of wave 4. And then after that, it'll go back up. It'll go back up. And so I won't go that far down the line, but in general, that's what's going to happen. Rates are going to go higher. So if you're looking for relief in these interest rates, you probably got the best rate that you're going to get in a long time right now. So they're going to go higher, or it's not a guarantee. They're likely to go higher. It's just a forecast, not a guarantee. But they're likely to go higher, come back down to about the same range that we at right now. Not much different. And then they'll go up even higher than that. And so this is a bad sign for anybody borrowing money. Um, but hey, it is what it is. If you know what's going to happen, you can prepare a lot better. So make sure if you're looking for refinances in your mortgage or your any kind of loans you have, um, be careful. Be careful. You might not you might not get a lower rate than what is available right now. So in conclusion, low rates are not gonna save you this time. We enjoyed low rates while we had them because of COVID, because of the pandemic. Rates went all the way down. We were able to get 2% mortgages, 3% mortgages, but I think that's done. Um, and that's going to have an effect. It has an effect on affordability of houses. And so, because of these rates and the monthly payments are high, homes are really unaffordable for investors and for homeowners. And so, that should have an effect of the prices going down. And home prices have already began to go down. I believe it's going to continue to go down. Um, I wish I could speak to the long term prices, like how far housing prices are going to go down, but I don't have a chart for that. But I have heard somebody say something that I do believe, but I'm not going to speak on that right now because I can't necessarily confirm it. But I do think house prices are going to go down and there will be a crash in real estate. And it will also affect stock prices because a lot of companies take out debt to fund their business, to grow their business. And so if their monthly payments on that debt is going to be high, those businesses are going to struggle. And so you're going to see a lot of businesses get wiped out, to be honest. Businesses who have taken out too much debt, they might disappear. Over the last few years, we've seen businesses disappear. I could list them off, but they've gone bankrupt and they're out of here. So be careful. It also has an effect on jobs. We've already seen so many layoffs. It's crazy. So just be careful. Just be careful right now. It's a tough time in the economy. You got to grind. You got to work hard, and prepare your mindset for the new environment. Things are not as easy as they were when the Federal Reserve was when the government was printing money and giving out stimulus checks and all of that. That time is over. Now we got to grind. Now we got to get it out the mud again. So switch your mindset. Uh, so yeah. So I hope this information is helpful. Stay blessed and peace.